The seeming decoupling or lessening of impact of interest rate cuts as a driver of economic activity and economic growth. Do you mind commenting on that, whether you agree with that and why that might be?
Well, I think my short answer is yeah. As you get lower, it's got less bang for the buck, particularly offshore where home loan pricing is not geared off the cash rate. So in the US, what you sort of get is you get the long bond is the key driver. In the past, interest rates quite often were a stopper, if you like, from actually doing anything because you couldn't afford to do it. I don't think anybody thinks that, or I certainly don't, moving the cash rate from 1.75 to 1.5 is suddenly going to say, wow, we can now do things that we couldn't do before. Because if you really can do it at 1.5 and you can't do it at 1.75, I wouldn't do it. So it is an issue. What you see increasingly is some of the countries like in Europe and particularly Japan becoming more desperate, thinking about what the hell can we do? And negative rates are not good. And the reason I think people keep saying, well, we'll just lower the rates. What they're really, when you get a negative rate, the guy in the street doesn't get a negative rate. Who gets the negative rate is either the hedge funds or the banks. And so what they're trying to say to the banks in particular is, don't give us the money, go and lend. But if you're not really sure what will happen, banks are still offshore, reluctant to lend. And effectively all that happens is that their essentially return comes down and they haven't got an ability to pass it on. So negative rates actually have negative impacts in terms of the banking system, which is a bit silly. The Europeans are slightly different. What the Europeans do in their negative rates is they say, okay guys, if you want to lend, we'll actually lend it to you at the negative rate. So in other words, they're paying the bank 60 basis points to go and lend. So that's slightly different to the Japanese system. But increasingly, they're getting more and more desperate. And I think one of the issues for Australia too is if you do get down to 1%, the RBA said in the past, well, we're not going to use up all our ammunition, so we might start playing around with different things. So we might start doing QE, for example. We don't have that in our forecast. But once you get to 1%, then I think I would keep some ammunition, and then you can play with, buy government bonds. So get the government. And the other one that's floating out there that the Japanese may do is what economists call helicopter money. What that basically is, think of it as the equivalent of writing a check, and you just send it out. You don't even try and neutralise it in the system. So that's pretty extreme, and that's had a really bad history. So you had a history in Germany in the late 20s, then Japan in the mid-30s, where it ended up with huge amounts of inflation. So you've got to be really desperate to do that. But generally, the last thing I say is I think there's too much focus on monetary policy. Sure, currencies are important, but also, particularly if you've got an ability to do it, you should be doing fiscal policy. You should be spending more money. And the way I would say is what we need to do is look at the budget and divide it up into two bits. Bit number one is what we call current expenditure. In other words, you should never be borrowing to pay for your public services and your running expenses. There's nothing wrong on the capital account to be borrowing, particularly at 1.8%, which is what a government bond will get for 10 years, and invested in something, be it infrastructure or something else, that will give you a return over the medium term. So I actually think this whole debate about, oh God, no, we can't use fiscal policy, is stupid. But unfortunately, the politics of it is, oh no, you've got too much debt. And surpluses are good and deficits are bad. Well, that's not economics, that's politics.